Zasubskrybuj nasz kanał, aby otrzymywać najnowsze komentarze zarządów spółek giełdowych, analityków i ekspertów inwestycyjnych. Partnerem programu jest spółka M-Food SA, największy giełdowy polski producent oraz dystrybutor miodów z całego świata.
Witamy wszystkich z konferencji, 24. Konferencji Rynku Kapitałowego. Mamy znakomitego gościa z nami, Colin Ellis, który jest dyrektorem w Moody's Investor Services. Pełni rolę Global Credit Strategist. Colin, thank you very much for having us, for taking the opportunity to discuss with us. Before, we had a great pleasure to hear your presentation about the global credit risks. And I have some key topics to discuss with you. So I would like to ask you about your opinion about the global resilience of the global economy. You mentioned that after the COVID, after the huge test that the global economy took, it turned out that the economy is more resilient than everybody thought. Why is that so?
Well, I think the really easy answer is because we thought the wrong thing before it happened. But if you think about the shocks that we've just seen, COVID, where many countries kind of shut down large parts of their economies, the reopening and the supply chain challenges that we weren't ready for the surge in demand once countries started coming out of the pandemic, then Russia's invasion of Ukraine, particularly here in Europe, and the knock-on effect, not just in terms of energy prices, but in terms of the transition away from using Russian energy. I mean, I think back in 2019, if you'd said, these are the shocks you're going to see over the next 3-4 years, and you're still going to have unemployment rates relatively low or falling in many places. You're going to have growth, not runaway, fantastic, successful growth, but you're going to have global growth of probably about 2.5% this year. I think we'd have been very surprised. So I think the real simple answer is, having lived through some of these shocks, we've learned that economies adjust and adapt and change maybe a little bit more easily than we would have thought before.
So it means that we will be more prepared for other shocks in the future?
Well, I don't know. I don't know if you're ever prepared for shocks, because by definition you can't see shocks coming. Otherwise they're not shocks. But I think it should give us a little bit more confidence that when shocks happen, maybe the economy will be a bit more resilient than we would previously have thought. And I think here in Poland is a really obvious example of that. So one of the key strengths for us when we look at Poland is just the resilience of economic growth and the fiscal position over a very, very long period of time. Poland is one of the most stable ratings we have, and it reflects, in large part, one of those key strengths being the resilience of the economy.
Still, you mentioned that there will be risks to come.
Yeah.
And it means that the economy will be exposed to certain risks. Some of them are predictable, some are not. So how do you think that the economy has the capacity to manage all those risks? Where this capacity may come from?
So again, I think in terms of responding to risks, we've learned that actually economies can move quite quickly by themselves. A silly example here is, back at the start of COVID, there weren't many face masks in the shops. And I remember by April of 2020, they were everywhere. That's a market economy responding. And it's a market economy responding without an awful lot of impetus from government. But I think if you look at the risks today, one of the challenges is the constellation of risk, or the type of risk we're seeing, is a little bit more challenging. So for us at the moment, we've just published our latest growth, our economic forecasts. And we've actually said that some of the kind of economic risks, will inflation bounce back up? Are companies going to be able to cope with higher interest rates? Things like that. We think those are probably diminished. Those risks are a bit smaller. But where we see the risks being particularly pronounced is in geopolitics, where we have the continuation of the war in Ukraine, which seems to be shifting slightly more in Russia's favor. We have the conflict between Israel and Hamas, which has already spread to skirmishes with Hezbollah and the attacks on the Red Sea shipping. So I think geopolitics is where we're focused right now. And the problem with those kinds of risks is they're very unpredictable. So in terms of the impact they have, and the kind of fallout on the economy, that's very, very difficult to get your head around.
But out of all those variety of risks that you mentioned, there are the risks that I would say are oldie goldie. I mean, the inflation is always something that we can think of. We know the inflation. We only can assume if it's going to rise or if it's going to be stable or fall down. That's the bet, I would say. But do you think that there are any other risks that emerge? I'm thinking especially about the climate risks, about the risks that are connected with sustainable development. I would say some of them probably have already been thought through. If the investors probably have taken into consideration certain of those risks, but not all of them. What is your view about that?
So it's tricky. We tend to focus on kind of broad themes that we think drive credit. And one of our themes this year is structural change. And one part within that is climate transition.
Yes.
And how we make that shift. I think the difference is that kind of risk is, by its nature, it's still very, very important, and it's still transformative, and it can drive people to default, or it can drive companies to be wildly successful, depending on how they respond. But it's slightly longer term.
Okay.
Whereas something like a geopolitical risk can flare up very, very quickly, and in a way that has a pretty big impact on global markets if it's then sustained. So when we talk to companies, of course they are focused on climate transition. We try to be transparent in our rating process about the impact that we see from those kind of factors, and not just environmental factors, also social, also governance factors.
Exactly.
But they're maybe slightly more longer term in nature. At a global scale, even if individual countries, individual companies might well be very exposed to, say, adverse climate conditions right now.
Okay, but you mentioned that the ESG risks are slightly longer term risks compared to other risks that are happening like right now. So does it mean that the ESG risks do not have impact on credit risk, or what is the relationship between them?
No. If we're doing our job properly, big if, everything that affects a company's ability to repay its debt should be factored into our ratings.
Okay.
And so we think we've always been thinking about climate risk and transition risk and social factors when we form ratings and when we publish them into the market. But one thing we've really focused on over the last few years is trying to be much, much more transparent.
Okay.
So for every single issuer we rate, you will find on our website a kind of credit impact score, or how much this is mattering, for the environmental factors, where we have our taxonomy and it's defined, for social factors, where we have a different taxonomy, and for governance as well. So we've set up the frameworks for how we think about it. We publish for every single issuer, this is how much this is mattering, or this is how this issuer is exposed. And on top of that, we have an issuer profile score, or IPS, which then kind of rolls the three together and says, this is how much in aggregate these things are moving the rating. So it's always been there, but we've made a massive effort to try and be much more transparent about the extent to which that impact is being felt.
Going forward with the risk case, we've discussed before that maybe there is a time when investors should more focus on risk. Actually, maybe they should start to think about taking risks and not to try to avoid them. What do you think about that?
I hesitate to give investors advice because
I'm not asking
we're
about
here
the
to
advice.
offer our
No.
opinions. But I think particularly in the broader debate in Europe about developing capital markets and the Capital Market Union project, which is still a priority for the European Commission, I think part of the challenge there is there are large pools of capital, there are large pools of money in Europe and in Poland, often from households, but they tend to sit in bank balance sheets. People like to put their money in the bank. And I think the challenge is to try and help people shift towards having a broader perspective of what they can do with their money. And with that comes some risk, but it also offers some opportunities. And I think the European country I would single out here is probably Sweden. And it's taken decades, but if you look at the progress that Sweden has made in terms of deepening its capital market and the engagement within that capital market, maybe not directly by individual households, but certainly via asset managers or pension funds or things like that, I think that's been a real success story. And I think the challenge really is, how do you make that happen in other parts of Europe? And some of it is this educational aspect, to build a little bit more of a risk culture.
Okay, so maybe final question, because we've discussed that during this conference, that there should be enough effort to like convince investors to start think about the risks and start to think about investing in capital markets rather than keeping assets in bank accounts. So what is the success story behind Sweden, what they done that allowed investors to convert from bank accounts to global capital markets or maybe Swedish capital markets?
Yes, it is very much a domestic market,
Okay,
although
home
there are
bias.
international players. I mean, there's lots of different things. I would probably single out two things.
Okay.
The first was the pension reforms in the 1990s were quite transformative in the way that they essentially, in effect, almost kind of created pension accounts for every individual citizen, or more or less.
Okay.
That's a broad characterization, but that transformation of the pension system, where everybody suddenly became much more actively engaged and invested in markets, albeit via their pension, that was incredibly important.
Okay.
I think the second thing I would point to is the development of the retail investment accounts, which basically give individual citizens the ability to put their money into small startup firms or larger firms on the stock exchange or whatever it is. And the tax incentives that were there, which were not enormous, but they kind of nudge people more in that direction. I think those are the two that I would point to. But I think the critical thing is when you're thinking about developing your capital markets, you can do lots of things on the kind of supply side. You can kind of ease regulation and you can reduce costs and all this kind of stuff. But you've got to go where the demand is. And I think for it to really be a market, you've got to follow where people want to put their money and make it easier for them there, and maybe nudge them a little bit to get them started. But I'm not convinced you can regulate a market into existence. I think that would be a mistake. I think you have to engage with households and other investors and follow the demand.
So it's like trying to create a positive environment and to some extent like a positive mood towards investments?
I'd hesitate to say a positive mood. I think the two examples I gave were, there were structural changes. The pension one was a very big one. The retail investment account was a smaller one. But they did create opportunities for people to engage with capital markets in a new way.
Okay.
And over time, as people got used to that and got more comfortable with it, that's what kind of built the culture.
Okay.
So it's a long-term project. And I think that's part of the problem, really. I mean, if this is something where you're only going to see the benefit really grow over a couple of decades, it may be tempting for politicians who have shorter election cycles not to focus on it. But the reality is, if this is going to take a long time, you need to start now because you still want to get there as quickly as you can.
Because this is a process.
Yeah.
And hopefully Polish process will also be, I would say, convenient, and we will take our advantage and opportunity to create stronger capital market. Thank you very much for this conversation.
Thank you,
you so
Anna.
much.
Partnerem programu jest spółka mFood SA, największy giełdowy polski producent oraz dystrybutor miodów z całego świata.